This is Listen Up Home Buyers, the only podcast dedicated to home buyers and the home buying process. I'm Victoria Ray Henderson, the host, and with me today is Paul Nowachek. He is a mortgage broker with Mission Mortgage, here to talk to us about everything that has to do with applying for mortgages, the difference between brokers and lenders. So, Paul, thank you so much for joining me on the podcast.
Yeah, thanks for having me, Victoria. I'm excited to be here.
First thing I need to get out of the way is tell me the difference between a mortgage broker and a lender.
Yeah, the best way to put it is that mortgage brokers are going to lenders for options. So mortgage brokers, we don't have our own money. We're using the money from the lenders. So with the mortgage broker, you have a lot more options. And two, also you have transparency on what the costs are. You see exactly what the mortgage broker is going to make on each deal.
When a buyer is shopping for a home, like my clients are doing this weekend, and they want to know what their rates are, they would contact you, and would you be able to give them different rates or interest rates depending on what lender they'd be working with?
Yeah. Oh boy, Victoria, this is a hot, spicy topic for me. So interest rates are a measurement of risk, right? So we take into consideration a bunch of different factors. Your credit score, which we sort of know, like we do a soft credit inquiry. It's not the full hard credit inquiry that's required. You know kind of how much the down payment is in the house, but you don't have all of the exact terms. So at that point, when you have a pre-approval and you're looking at houses, we're projecting what that interest rate is for that day for a specific scenario. And usually we'll say, okay, this is going to be a contract that closes in 30 days, or some lenders will do 15 days. It's very difficult at that point to say, oh, this is my interest rate. It's not an interest rate. It's a mythical number that exists that we're using in our calculation to make sure that you qualify.
Mm-hmm. Okay, so it's my understanding, correct me if I'm wrong, please, that when you're provided an estimate from a lender, that estimate has to either be less than, but you can never be expected to pay more than what that estimate is that they provide for you in the beginning of the transaction.
Okay. So yeah, now we're moving forward into a transaction.
Mm-hmm.
Before on a pre-approval, you're talking about worksheets, numbers. There's really nothing binding to that at all.
Got it.
Once you get a contract, and you're like, all right, we're going to move forward with Paul, then we have to provide you by law a loan estimate.
Mm-hmm.
And within that loan estimate, there are certain sections that can and cannot change and have a variance. We don't know like what some ancillary costs are going to be. Like maybe there's like a water bill or something that pops up. Like
Right.
that's not in our control. So there's no binding to that or no boundary to that.
Yeah.
So some are and some aren't. And that can be very tricky to understand. But of course, a good loan officer, a good mortgage broker, a good advisor is going to walk you through that in the beginning, like well in advance of that loan estimate. Here are the numbers that are going to change. Here are the assumptions that I've made. We don't know what your homeowner's insurance is going to be. We don't know if you're going to have an HOA fee.
Yeah.
All those things are conversations that should have happened well in advance before that.
So walk me through all of this from the beginning. So from the beginning, somebody is going to be looking at a property, and let's say they contact you and say, hey, I'm looking at ABC house in Ashburn, Virginia. It's in an HOA. XYZ house is not in an, and here's the listing. They're asking you to provide estimates for these two properties. Walk me through how you would do that.
Yeah. So if I have two different properties that I'm comparing side by side,
Mm-hmm.
I'm going to go directly, let's assume it's in Montgomery County. I'll go directly to the county website to get the taxes, the property taxes from there. I'm going to take away the $692 because we know that's going away, right? And I'm going to use that property taxes for each individual estimate. I'm also going to probably do the same homeowner's insurance for each estimate because the houses probably should be very similar.
Right.
And then from a payment perspective, we're going to assume, like most people will just say, hey, I want to do 5% down or 10% down. And I will start there and I'll have a conversation with everybody. I'd be like, what is the number that you guys want to evaluate at the highest point? Or what do you want to see first? And we'll go from there. So side by side,
Right.
we'll see everything as to compare with the HOA, with all the thing, insurance in there, the property taxes, and it'll be as accurate as we can get. The longer you go on a transaction or a contract, the more risk there is to the lender. There's more uncertainty in the future. So more uncertainty, more risk, the interest rate's going to move up.
So buyers frequently have ideas about how this works, and sometimes they're right, sometimes they're wrong. I'm going to ask you a few questions. You tell me what your answer is because these are really common first-time homebuyer questions. Do I need to have 20% down in order to buy a house?
No, you can do as little as 3%, 3.5%. If you're a veteran, you can do 0% down. So 20% down is not the requirement.
And talk to me about why 20% is such a popular down payment. Address that private mortgage insurance issue.
Yeah. So when you have 20% down or more, there's no mortgage insurance required on a conventional loan, the private mortgage insurance. So that's kind of where that comes from. Private mortgage insurance isn't a bad thing. It's a great thing that allows us to get more leverage with our money. And quite honestly, because there is this insurance in the 20% or less range, that sometimes might improve the interest rate significantly because there's less risk there, right? We're talking
Mhm.
about risk this whole time.
Right.
Credit scores. Also, the same thing. You add in mortgage insurance, private mortgage insurance, that could increase or decrease your credit score. Also, a little known thing is that like if you have two people, that also gets you a lower mortgage insurance premium because there's less risk with two people than there's one
There's
person.
just one. That makes sense. So talk to me about credit scores when I look at my credit score. So let's say that I look at my credit score on Credit Karma and it's 150. Is that an accurate assessment that I could use and trust in terms of getting a loan for a home?
It's not going to be an accurate credit score for the mortgage process. It's a great product for you to monitor and make sure that your credit, there's no issues. But when we have a credit score from the mortgage process, we're paying for it, sometimes hundreds of dollars.
Hmm.
You're not paying for your credit score, so you're getting a very diluted, watered down version, right? It's a product that's out there that somebody's paying for on some side, but you're not paying for that.
Mm-hmm.
So it's a great tool, but it's not accurate for the mortgage process.
Okay, that's good to know. A lot of people have I would say, misconception that that is their number and that's their accurate reading.
That is, and that's something that we deal with all the time. That shouldn't deter you from talking to a mortgage professional and having your credit reviewed.
Yeah, yeah.
Um,
And the credit score is in direct correlation with the interest rate that you're going to be getting.
so it it is a factor, right? There's
Uh-huh.
when we're making an interest rate, we have building blocks. So,
Hmm.
like I said before, down payment, credit score, a property type is one, like a single family home or condo. Your rate lock period is one. The loan type is another. So all these different things are building blocks for the interest rate. So the credit
Okay.
score, yes, it does affect it, but not. I couldn't tell you what percentage of it is, but
Talk to me a little bit about the closing disclosure, the document that's required to be provided to the buyer at least 3 business days prior to closing.
yeah, actually, that's a great question. So it is a law that we require that on residential homes, and unless it's like an investment property, like hard money, that's different, right? But what we're talking about, real estate and a primary home, secondary home investment properties through conventional lenders, it is a requirement.
Hmm.
So the closing disclosure is a sibling document to that loan estimate that you get in the beginning, and it is going to hold the lender accountable to the numbers in the beginning. Remember, there's
Right.
tolerances to different sections, 0, 10, infinite. And if the lender is not within those boundaries, then they have to absorb that cost
Hmm.
to move forward. They're
Hmm.
saying you didn't disclose this properly.
Hmm.
Lenders are allowed to change it when we find out new information, right? So if we find out something that has changed those numbers, we have 3 days to submit for a change in circumstance that gives us an opportunity to redisclose. But you can't all of a sudden say, well, I'm going to change what I want to do and I want to pay points now for a lower interest rate.
Right.
Well, that we are allowed to redisclose that to you and say, hey, here you have made a decision to pay points to get a lower interest rate, and here is what your new numbers look like.
Hmm. Hmm. I work with a lot of first-time homebuyers because we teach classes to educate, like you. We like to educate consumers about this whole process. And something that comes up quite frequently, and especially now with the affordability issue that people have just being able to get into a first home, a lot of first-time homebuyer programs that are out there. Some are national, most are pretty localized. I know DC has a program, Baltimore City has several programs. When someone works with you or works with a lender, does the lender typically research to see what program will work for them, or is that really the responsibility of the buyer?
Oh, that's a good question. So, like, yes and no. Really,
Mhm.
I would lean on your real estate broker. They
Yeah.
are going to have a wide variety because some of these down payment programs or grant programs are only going to be specific to a one lender.
Hmm.
So, while I started off beginning my career thinking about all those opportunities and everything that was out there and trying to absorb that, and it's an impossible task because
Yeah.
these are always shifting,
Right.
changing, within the scope of what I have access to. Of
Hmm.
course, I
Hmm.
will provide that and say, "Hey, here are the options." But
Yeah.
certainly that is not all inclusive. Even if you have somebody that says they specialize in down payment and grant money, that doesn't necessarily mean that they have access to everything. It's
Yeah.
impossible.
Yeah. Yeah.
So a lot of it is going to have to be on the buyer to do some of their due diligence, and that's work with a real estate professional like yourself,
Right.
Victoria,
Yeah.
to identify, hey, I know this great product over here that exists and you want to take advantage of
Yeah.
and go from there.
Some of the grant programs, they start to run out of money as the year goes on. So just a heads up as buyers, if you start like in January and February, you're more inclined to get access to that grant money because it starts to run out. At least that's the case in Baltimore City, I know.
A lot of it is about timing for
Yeah.
sure.
I have many buyers who ask me upfront to provide them a list of recommended lenders or mortgage brokers because they want to, as they say, they want to shop the rates, or the interest rate. Can you talk a little bit about that?
Yeah. So that's another hot topic for me as well. One thing that they're familiar with is like, what's my rate? What's my payment? Right. So that's a
100%.
lot
Yeah.
what they focus on, especially early on in the conversation with lenders, loan officers, brokers, all of us. And the mistake there is that an interest rate in the beginning, it doesn't matter. Right. It's important because we
Hmm.
want to say what your payment is. We want to look at what it could be, but the interest rate is constantly shifting and changing, sometimes multiple times a day. So
Hmm.
when you are talking to somebody early on in the stages, it's more about trust, transparency, education. If they're competitive, if you go online, you look at interest rates, everything is quoted with a half point or 1 point in the
Hmm.
absolute best scenario possible. An
Hmm.
interest rate's a fingerprint. It's unique to you and that specific point in time. As soon
Right.
as that point in time is gone, it's not relevant anymore, or
Yeah.
possibly not relevant.
I've often had buyers check, kind of meet with a lender and then a week or two later meet with another lender to get the interest rate. And I said, listen, if you're shopping like that, do it all in the same day because you are comparing at that point apples and oranges, with,
100%. There can be a huge shift in the market in a day, in
yeah,
2 days,
yeah,
especially right now. It's with what's going on. A
yeah,
week from now, it's very different. You could even have your credit score, that soft credit inquiry, and you could get another soft credit inquiry a week later, and all of a sudden you've had something paid off, or your credit card's been reported with a payment on it, and your credit score is completely different, right?
right,
And so
right.
it's not an apples to apples comparison when you're talking about, and it won't matter because those two soft credit scores, you still down the line, you still need to have a hard inquiry with one credit inquiry, and
Hmm.
that's what's going to matter is that real hard credit inquiry.
Yeah. Yeah. There's so many moving parts to the lending, but I think you'll agree that you have to take it in steps. And you've got to work with people who are going to be answering your questions and then troubleshooting and being one step ahead of you